Okay, so I would like to welcome our second set of panelists, and again some very familiar faces to the stage. I have to my left Tim Rowe, who's Manager Trading Platforms and Settlement Policy at the FCA. And then to his left we have Saurabh Srivastava, Global Head of Electronic Trading at Invesco, of course, who we heard from earlier this morning. And then to his left, Brian Schwager, who is Head of Equities at the London Stock Exchange Group. And then to my right, Mike Seen from Goldman Sachs, and Byron Griffin, who's Head of Equities at Thomson Reuters. The subject of this panel is about dark trading and the future of dark pools under MiFID II. Now, we've all seen that dark trading in Europe has become increasingly popular and grown significantly, with those that study it estimating that total value traded in the dark in Europe is in excess of 10% now, and quoted of growing around about 50% last year. So it's become something that's increasingly prevalent in the European marketplace. Yet within the regulatory debate around MiFID II, dark pools have had a lot of attention, and we've now seen within the MiFID II Level 1 text some very specific rules around dark trading. And so we're going to debate the kind of implications of that and what we think the future of the landscape will be here on this panel. Now, before we get into the new regulations, I just want to touch on what we see as the kind of current trends in dark pools, and what we think the current drivers are. So Mike, if you could start by explaining what you think is driving the growth that we've seen in dark trading in Europe. Is that particular sectors, countries, and new participants, broadening out of the scope of instruments that you can trade in the dark? Is it the low volatility? Give us some flavor as to what you see as the kind of context around that.
Yeah, I think the growth in dark has been driven by a number of things, but primarily by the client-based demand for trying to trade in a blockier environment. Now, there's been various different solutions. Some of them haven't worked as well as others in terms of trying to create that blocking environment, but that's the first and foremost driver. And then if you look into where we're seeing the different percentages of ADV trading in the dark, if you segment that by market cap, you'll find that particularly in the UK, but it's true across Europe, that there's by far and away a larger segment of the average daily volume traded in small and mid caps than there is in large caps, trading within the universe that you can measure, which is the MTF component of the darks. That sort of side. And there's a pretty noticeable gap, and I think there's been some research out recently talking around that. Okay,
thank you. And Saurabh, in terms of the value that the buy side get out of dark pools today, what's the real buy side perspective on the current dark trading and the offering that's available to you?
I think one of the features of dark liquidity pools in general has been that, as Matt talked about this morning, that buy side trading desks, it's about not being able to tip your hand, right? You don't want to have information leakage, and you don't want to display your order size out to the marketplace and signal to the marketplace that there's a large buyer or seller. And so to the extent that the dark pools help solve that problem, I think that's been one of the roles that dark pools have played in the context of the buy side utilizing them.
Okay, great. Well, let's move into the kind of regulatory debate and what's going to happen around MiFID II. And Tim, it seems obvious to start with you to give us a description of what is coming in the new rules, and at least what we know that's kind of been set in stone around level 1, and then we can talk about what we think is going to come next.
Yeah. Okay. So in terms of, am I on? In terms of the dark space and in cash equity, quite distinct from the whole non-equity space, which will also have a transparency regime under MiFID II. I think the key thing that always stands out for everyone when I have this conversation is the 4% and 8% caps, which will be introduced on the amount of usage of the waivers. Of course, one of the things which has sometimes got a little bit lost in the discussion around this is that the 4 and 8% caps that everybody's heard of don't apply to all dark trading. It's actually about effectively 1.5 usages of the 4 waivers. So just very briefly, the 4 waivers are the reference price waiver, where you trade on a system which derives its prices from another venue, the negotiated trade waiver, where you do a trade on an off-book basis, report it to a venue at or within the spread, or because that trade is subject to conditions other than the current market price, it's a non-standard settlement cycle, for instance. There's the order management facility waiver, which is all about sending orders to a venue and those orders remaining dark for some reason, might be something like iceberg functionality. And then there's a large and scale waiver. Now, of those waivers, it's only actually the first, the reference price waiver, and half of the negotiated trade waiver, that for the trades at or within the volume weighted spread, which are actually subject to the cap. All the other stuff, so for instance, large and scale, is not subject to the cap, which is important because when you look at the 4% and 8% caps, they look pretty darn low. And the fact that it only actually applies to a chunk of the dark liquidity is important. And of course, you'll still have the ability to trade OTC to an extent, but there will of course be now a non-venue trading obligation to help draw OTC trading and cash equity onto supposedly the lit venues. So that's very much fixed. We've got those 4% and 8% caps. We know what they relate to. How the actual mechanics will work, of course, is a completely different thing. How will we make sure we've got the right data to be able to judge where instruments sit vis-a-vis those limits? How will the industry go about managing trading versus those limits, and how should that be organized? These are all questions to be answered in due course. And quite aside from that, with respect to things like the large and scale waiver, they might not be subject, those trades, to the caps, but where the large and scale threshold sits for any given instrument is an open question, and it's something that ESMA will be consulting on in due course, should the thresholds go up, down, or stay the same. So there's a mixed bag at the moment of what is currently fixed by virtue of the level 1 legislation that was agreed a couple of months ago, and what is still in a state of flux. An awful lot of this, though, will be explored in the next couple of months as ESMA starts to produce consultation documents.
So that sounds as though there could potentially be some very significant impacts on dark trading, but as is always the case, the devil is in the detail. We've still got the next stage of the regulatory debate to unfold. And we also all know that the marketplace can be very nimble in finding, ways to achieve compliance whilst continuing to provide, a good service and good value add to the client base. So, Brian, a question for you. Like, what do you perceive as the impact on dark trading as a result of, what we know so far around the new regulation?
Well, I think that, is that on? Good. In terms of the 4 and 8 caps, as Tim said, it only really applies predominantly to the reference price waiver and part of the negotiated trade waiver. I think the issue that the industry has is that if we look at dark pools today, most of them are operating under the reference price waiver. Most of the executions that we see going on in the dark would come under the reference price waiver. So the challenge for the industry is now, what can we do with that flow? Do we simply put it onto the lit venues, or can we find other ways of trading that which would be within the new cap regime? So, some of the ideas which have come from the industry, both here and from the US, so we're talking about things, for example, we mentioned earlier this morning, intraday auctions. That's obviously something which the LSE is currently consulting on. New order types, for example, conditional orders. So this is the idea whereby a tentative order is placed in a dark pool, and where another order comes which could potentially match with it, they are firmed up and brought together. The advantage of a conditional order type is that it allows for a larger execution to take place, thereby hopefully increasing the number of large and scale executions that the dark pools might be able to have. Other execution types, again, will be things such as systematic internalizers. And I think that really the solution for this is not going to come from the market venues themselves, but actually from the brokers and potentially also from the buy side, in terms of putting together algorithms which are actually able to use all of these various tools and come up with solutions for the end investor.
Okay. And Byron, question for you on the vendor side, but related generally to data. The ability to understand what's going on in the dark is something that has been challenging over the years, right? Not all of the dark pools currently identify that, that certain activities taken place within their venue. And we are going to need to see the volume that's being executed under the 2 waivers or the 1.5 waivers that are captured within the volume cap. So How is the industry going to evolve around data and understanding what's going on in the dark, and specifically what's impacted by these volume caps? What are the solutions going to be around that, do you think?
Well, as you said before, the devil is in the detail, especially with level 2 coming out. But one of the key, obviously, pieces around MiFIR and MiFID is transparency in the market. If we go back to why the evolution of dark pools and why dark pools exist, one is to obviously execute the block flow, but the other piece around it as well was really finding a path of least resistance around potentially the cost structures that existed in the market to execute that flow on the lit markets. That's why potentially you saw a lot of that child order flow going through the dark venues. So part of the interesting way MiFID and MiFIR is potentially tackling this is through the waivers that they're introducing and through the strict application of those waivers is going to enforce a heavy, I've lost the word for it, but it's going to increase the importance of a central order book tape. Now, how that gets implemented, that could be implemented in multiple different ways. It could come from a regulatory where it's mandated down. There's a lot of cost structures involved in that, and it's been done in the US. It took 7 years to do in the US. It's quite burdensome now to manage, and there's even some people, some market participants that are now looking to change that order book structure in terms of that central tape structure to make it more flexible for what they're trying to achieve. So is that the right fit for Europe? Potentially not. Maybe the right fit for Europe is where you have a mix between regulation and market-led. So an example might be where we stipulate from a regulatory viewpoint what exactly is the central order book tape and how that should look. And a part of that and the unbundling of that to make it more cost efficient for vendors and for buy side and sell side if they don't want to use a vendor product to put it to reconstruct the tape themselves. But there needs to be extreme clarity on exactly what does constitute the tape. Now in Europe it becomes more complex because you've got multiple currencies as well. So now you have the issue of does a central tape include those cross currencies? And if it includes those cross currencies, what do you use for the FX rates for a conversion of that? Because now when you go to create a VWAP price across the whole market, it becomes a very tricky question. And if you're using that VWAP for best execution and marking best execution, the question becomes even more potentially interesting. So
it's one of those where we don't really know yet, and we're going to have to see how that plays out. And there's a lot of potential options, right? And this is something that will be heavily discussed. So let me move on to you, Mike. What is the future of broker dark pools? You know, we know today there are some systematic internalizers. We know there are what's been coined the kind of broker crossing networks, which are within the OTC space and regulated as such, but don't have a dedicated category. What will they become? What are the options? And what do you see the kind of main direction for brokers with their dark pool offering?
I think there'll be a range of solutions, and I think everyone will come up with their own sort of process. But the way we're thinking about it, and it involves quite a lot of the sort of techniques that Brian's spoken about earlier on, but we would sort of think about it in three sort of main levels. The first one would be we certainly need to work on, in the algorithmic layer, how do we improve the child order size? So starting to aggregate child orders, those sorts of things. And you get into the sort of the world of trajectory crossing, and things will get larger. There's greater demand from clients for larger blocks. That all makes sense, and those would presumably get large enough to be under the large and scale waiver. The second component, which I think is probably more interesting, is the component of the whole contingent order type scenario, where if you think about from a broker's perspective, certainly from our perspective, when we look at the breakdown in dollars traded between the electronic business versus the other businesses, it's roughly 55-60% of notional dollars traded every day is self-directed by clients. Now, it seems kind of crazy that if clients are looking to trade bigger blocks, why that should always be walled away from the environment where larger blocks trade, which is typically in the cash business. So the whole notion of contingent order, I think it applies to brokers' business models too, in the sense that we have to really work on how do we change our business models so that we can make those two interact if clients want it, and that's a big if. So within Goldman, we certainly worked on what we call visibility, where we give clients the ability to click on a parameter on their algorithm to make that information available to the cash world where blocks tend to trade. And we've had quite a lot of success with that. We're seeing about a 70-odd% pickup in price improvement as a result of that. And then the last component, I think, plays to the SI in the sort of sense that if you read the research which is out at the moment in terms of talking about where will the caps have greatest effect, it alludes to what I was talking about before in terms of, it'll be in the mid and small cap, the more liquidity challenged world. And from that perspective, if that does get impaired, if our clients' access to liquidity gets impaired in the future, then that probably leads to more demand from our client base towards broker capital. So working towards solutions to provide broker capital, probably electronically. So we're talking things like greater build out of DCA type products, greater build out of tradable IOIs. We've just been working on something called Blocks, which is a tradable IOI product. Those sorts of things by brokers. And because our the demand for capital will go up, we'll need to figure out as brokers how do we manage that risk. And I think that's where the SI regime will really come into play, is providing an ability for brokers to manage their risk and do sort of bi-party transactions through the SI regime. I think that's how it plays out. So I don't think there is one solution, but it'll be various different problems.
Which is good, because when we recognise the value of being able to trade, whether it's in the dark or the lit, we want to be able to provide customers choice, right? Choice of different execution channels where you can select what you think is going to be the optimum way of achieving the execution that you need to do. So when we think about the regime around systematic internalisers, I'm not aware, but do correct me if I'm wrong, that there's been much change to the SI regime proposed or now laid down in the level 1 text around MiFID 2. So Tim, what's your perspective on the kind of transparency regime that exists around the SI and how that's going to operate in the future?
Yeah, I think what we'll see is probably more evolution, if you will, rather than revolution. I think the expectation is systematic internalisers will make two-way quotes of meaningful size in the future, and a question that will exist is what happens to the SMS threshold that is key, the standard market size threshold, that is key to the systematic internalisers. Will it rise or will it fall? So I think there will be an aim to make the SI category more meaningful. I think one of the surprises, a twin surprise, I guess, of MiFID 1 was one, that the systematic internaliser category appeared in the first place. I don't think a lot of people saw that coming when the negotiations started, but they were certainly aware of it by the time it finished. And then secondly, the fact that actually in practice, it's not been a category that was populated by the firms that I think a lot of people expected. I think a lot of people thought every major sell-side institution would be right there. And on day one, I think we had literally about half a dozen firms that were categorized as SIs. And of course, that's an instrument by instrument thing anyway. So even if you are an SI, you're only an SI in given instruments for which you have claimed yourself to be an SI. So I think the whole thing will just be building it out to make the obligations more meaningful, the number of people caught more representative of what I think was anticipated when MiFID 1 was written, and maybe something crunchier around proper two-sided quotes there. But that's hardly creating something completely new. It's, as I say, it's more of an evolution, I think.
But has anyone ever actually traded off of an SI quote? Brian?
I believe they have, yes. And we do have a couple of systematic internalizers who are quoting on the LSE. And as far as I'm aware, they have executed under that scheme. So, I mean, it hasn't been, I would have to say and agree that it hasn't been terribly active so far. But it is an opportunity, and it's going to be an opportunity which clearly the sell side is going to start looking at under a MiFID 2 regime. I think it's one, if we're honest and we look at it and thinking, back when I was on the sell side, the broker crossing network was offered a much easier regime to execute under in terms of the obligations. It also offered a wider range of liquidity, which you could execute as well. So it was a broader solution, if you like. The systematic internalizer was viewed to be a much narrower solution. But I think under MiFID 2, and to Michael's point, I think that the solutions under MiFIR II are going to be about smarter algorithmic trading, which are going to take advantage of a number of different options. Systematic control analyzers are going to be one of those options.
Now, Saurabh, you did your talk earlier today and talking a lot about algorithms and the buy side starting to take more control over that. And there's a general theme in terms of people getting to grips with how to leverage technology within their trading mechanism, right? And you touched on this around kind of automated capital commitment, right? And the role that the broker can play in that. Do we think that as a result of these regulatory changes, we're going to see dark pools kind of go back to what you might say was their original purpose, right? If you think about when LiquidNet and kind of POSIT crossing first came in, and it was more around block level crossing. And that now you're looking as brokers at solutions within your algorithmic capability and how you identify the crossing opportunities, higher up the chain in terms of the order flow. So Saurabh, what's your perspective on that as in terms of the purpose of dark pools, and are we going to go back to that kind of more, it's about blockier execution taking place within them?
Yeah, I mean, I think that was the original intent of dark pools, and somewhere along the way, it came, as was alluded to earlier, that it became more cost efficient to execute other types of transactions in dark pools. Not having to route out orders to the exchanges meant savings for brokers, and really just meant that there were other types of order flow that you could internalize in dark pools. Is that necessarily a bad outcome for the buy side? I don't know. I think the question is outstanding. There's, again, as I mentioned in my talk, if you look at what the U.S. regulator is doing, the Securities and Exchange Commission, they've really taken a much more data-driven approach towards answering a lot of these questions. And I think as a buy-side market participant, we'd like to see the same kind of thing drive the decision-making process as to, what are good changes for the market, what are bad changes to the market. That should be governed by, quantitative evidence that supports one claim or the other.
Mm. And what's going on with that? Because, quite often we'll see politicians asking, for the buy side to give them data. And then the buy side say, but we're doing that through our trade association, whether it's the IMA or the ones on the continent. They feel as though they've been able to provide data, but for some reason there seems to be a major disconnect between that data somehow getting through and being, whether it's listened to, analysed, heard, or whatever. I'm interested in the panel's views on that kind of topic, right? In the empirical evidence that we would like to see underpinning some of the changes that are coming through.
My sense is the buy side have done a pretty good job of providing that data, but you've also got to remember that there are other components who also have the ear of the policymakers and the regulators, and the sort of exchanges will be sitting at the other end with a very different very different viewpoint, also with data, and we still hear lots of reference to very bad data, the 40% number, and all those sorts of things, which are we've got to remember we're dealing with a lot of different business models and a lot of different desires, and that process is going on. I think the buy side have done a pretty good job of presenting data there, personally.
Yeah, I think they've certainly sought to, right? It's just whether that voice quite gets heard. Now, what about the LIS waiver? Because that's something that within the next stage of the regulatory discussions, we'll see a lot of debate around the threshold. And various market participants have been calling for a number of years about those thresholds being reviewed. And they need to be recalibrated to come in line with kind of current market conditions and activity. How do you think that's going to play out?
I think that's a pretty tough question, because, as I said earlier, there are essentially three things you can do with a large and scale waiver threshold, right? You can put it up, you can put it down, and you can keep it the same. And that's the very, very simple kind of synopsis of the way the world works with these things. Actually, in practice, it's considerably more complex than that. It's a spectrum between reducing it to virtually nothing to putting it through the roof such that for any given instrument, that threshold is so prohibitively high it will never be used. So the question comes down to, what data can you produce? What can you produce that justifies saying, well, we've looked at this, and bearing in mind what we trade, we think the threshold should move in this direction or that direction, and by how far? But of course, that depends, or the extent to which that gets any traction depends on whether somebody is looking at the markets and thinking, what is a reasonable usage of this waiver? we've got to protect this, we've got to allow people to continue to use the large and scale functionalities, or whether they're coming at it from a different philosophical position, and some people are, who are saying, well, actually, you know what, the whole theme of MiFID 2 is transparency and increasing it, and that means the waiver options of up, down, or keep it the same are actually only two. You keep it the same or you put it up. And there are people in the game out there on the kind of regulatory and government side who want to do that. They want to either keep it the same or put it up. And I think, you know, we from the UK side are very much arguing for, at least for the purposes of a discussion paper, which you'll see coming out of the European Securities and Markets Authority probably in June, just asking a straight question, up, down, or keep it the same. And trying to be as open-minded as possible. And that's where the data does come in. And the more people can make an argument saying, we think it should move in this way or that way by this amount because the data analysis we've done suggests such and such, the better, because that's what becomes compelling in the decision-making.
Just to add to that, I would say that with one of the key tendencies of MiFID 2 being to push order flow, the child order flow, back onto the lit market to increase the price discovery process, the efficiency of that process, which I think is a very good thing to do. You're in a position where you can actually say, well, the argument now is to maybe create another level with your large in scale, where you have if you like, a super large in scale level, where if someone on the buy side wants to build a truly big position, they're given a longer period to build that position before everyone else on the market can effectively piggyback on that and increase. I mean, there's been a lot of conversation, obviously, recently around high-frequency trading and the cost to the end investor. Well, the large in scale probably represents a bigger risk to the end investor if not applied correctly, because there's a much larger risk there in terms of what the end investor could incur if the reporting of that is too soon. Especially for, we've heard a lot of this from the buyer side across the street. And I know when it comes to the level 2, they're going to be very, very active in that conversation.
Yeah, so I think that starts to pick up on two related issues, which are the large in scale waiver from pre-trade transparency, which is very much binary in nature. You're either above a threshold or you're below it. You're below it, you're lit. You're above it, you're dark, for at least as long as you stay above it. You get part executed, you drop below that threshold, you become lit. So it's very much that kind of, you're either one side or the other. Separately, of course, very closely correlated to it is the deferred publication regime for the completed trades. There, what you've got at the moment, as people will be aware, are delays that can last anything up to the end of the third day after the trade took place. You ain't going to get that in the future. There's no doubt in my mind that the level of delays that you get for any given size of trade are going to suck in a long way. We're going to be looking at a lot more stuff which has to be published end of day. You might have a push over to early the next day, maybe lunchtime the next day. I think, again, a lot of this sort of stuff will be set out in the ESMA documents, which will consult. But you're not going to see the 2-day delays, 3-day delays anymore. So you've got these twin things going on with the deferred publication on one side for the trades that have happened, and then the large and scale threshold for the pre-trade.
Two things
Actually,
in that.
I was going to just jump in and go back to what we were talking about earlier in terms of our options around LIS and the caps, et cetera. I think there's more than up, down, or sideways. I think there's also a question about how we actually apply that cap, and perhaps becoming more sophisticated about the way in which we apply the cap. And here I'm thinking about something which some of the sell side call the virtual block. And the idea around the virtual block is very simple. It's this. If I start off with a parent order, or I expose an order into a dark pool, and I go around and I execute in, say, 3 or 4 different dark pools, if I looked at those executions on an individual basis, chances are none of them will actually add up to a larger scale. But if I actually combine them into one, and I said, well, look, that was actually one order, and that does add up to a larger scale, then that perhaps is something that the regulators should be thinking about as well. I mean, as we, the whole idea around MiFID 2 and MiFID 1 even was to introduce competition to the execution space. If we are going to support competition, then we should actually, be open-minded to different ways in which we apply some of these waivers.
Yeah, and whilst conceptually I can understand that, I can buy it, I think the chance of you getting that out of the level 2 is as close to 0 as it gets.
Yeah,
I'm afraid.
I know. I just thought I'd throw that in there.
Yeah, no,
Thanks
appreciate
for
that.
the optimistic
No, that's
comment
okay, I'm a
there.
regulator, it's my job.
So, we know that the politicians and, the regulatory debate has hung around the mantra of transparency, 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 right? It was at a conference years ago where one of the MEPs stood up and said exactly that. So are we going to see, as a result of these dark rules, volume going to, more volume going to the lit market than it currently does today? And is that what people actually want to see happen?
I think we will. We have to, by the nature of the rules. But will there be, again, to the point that I was saying to you before about with that increased volume going to the lit market, and the rules also around the waivers and the 4% and the 8% volume caps, the need for clarity around a consolidated tape and exactly how consolidated tape is constructed is going to be, it's going to form a backbone, if you like, of the whole MiFIR process all the way through. And the devil, as you said earlier, will definitely be in the detail there. If we don't get that right, it's going to really affect the effectiveness of the whole process.
I personally don't think that you'll see that shift where you can say that volume which was in the dark will show up in the lit. And if you take the extreme example where a stock trades 5 times a day, and a client has a large order which is whatever it is, 100, 500 different average trade sizes in size, the right venue to execute that is not to trade, try and make that stock trade 20 times in a given day, because it defeats the purpose from the client's perspective in terms of it. There's a lot of signaling risk. We know that the most amount of signaling risk is in the lit market by definition. So I just don't think that's the solution. The solution will be very much what we were talking about before in terms of if a client has a very challenging liquidity problem, they're either going to use broker capital unless we can provide some sensible way for them to be able to source that liquidity in a reasonable way.
Yeah, absolutely. I think perhaps one of the unintended consequences is going to be the return of the human. In terms of market maker or the sales trader who's watching the algorithmic order, and as you said earlier, Michael, it turns around to the client and says, hey, look, I see you're trading this all day. I can put together a block for you if you like.
The other point on transparency is I think we need to be super clear about transparency. I don't think anybody wants perfect pre-trade transparency. The debate on transparency should be much more on post-trade transparency and how we sort out our post-trade tape. The debate on pre-trade transparency, it's a really naive debate to say that we should all display our hands. It makes no sense. That's not the issue.
Okay. Final question from me, and then I'm going to throw it over to the audience. I'm giving you a heads up this time. We've obviously seen in the last week the furore around Flash Boys and a lot of commentary there around the IEX platform, which is the dark ATS in the States. Do we need an IEX-style platform here in Europe?
I think it's always hard to oppose a populist view that sort of if you have an exchange or an ATS that's been designed for the buy side and claims to have features that are anti-HFT, it's hard to oppose that and say that that's bad and that shouldn't be something that the buy side doesn't want. Or that is something the buy side doesn't want. But what I'm more interested in is really understanding the true value proposition that an ATS like that can bring and the impact that it can have on execution quality. I want to take the conversation a little bit away from the fluff and the sort of marketing aspects of IEX and really delve into the exact mechanics by which we think we can get better outcomes. I think the jury's still out on that. And so to answer the question, I think is, do we need a venue like that? Sure. But, let's understand how that's really going to play out.
My sense would be we've got to wait and see somewhat how it plays out in the US, and we've also got to remember that the market structure in the US is a very different beast to the one that we interact with here in Europe. So I think my sense would be yes, we should focus on trying to help improve our own environment. We should focus on trying to reduce complexity in the European environment. We should, also the knock-on benefit of reducing complexity would be to focus on, improving stability. And I think both of those things is really where we should be spending our time.
Yeah, ultimately all about execution performance and how we can improve our understanding to optimize that, right? So over to the audience. Who has a question they would like to ask our panel? I think I can see Richard Seamark there. Am I right? You're in the dark at the moment. How ironic. Finally, I got a joke in. Excellent. Mike is on its way to you. So Richard Seamark, no doubt with a killer question for
Brian,
the
this
brokers
question is
on
going to be for you,
on
I think.
on our panel,
Yeah.
ex-broker, now exchange.
Richard Seamark from UBS. Given the concerns around high-frequency trading, but also the desire for clients to trade with natural liquidity, is there not a case that the regulators and the politicians will end up embarrassed by the fact that they've brought about a market structure which makes natural liquidity harder to trade with and forces client flow onto the place where the high-frequency firms would most like to have it, which is the lit markets? That's for Tim.
Yeah, there was me looking along the line thinking there must be a politician here somewhere. Damn it. It's an interesting question because it's not the first time it's come up. The idea of having an on-venue trading obligation, a desire to compress dark trading and put stuff more into the lit, and as a part of a pushback, if you will, an increasing in the regulatory requirements on HFT and algorithmic trading firms, having this provision people may have heard of, it's been known historically as Article 17.3, which is this mandatory market-making obligation on firms that follow market-making strategies, albeit maybe not as officially market makers, requiring them basically to be market makers going forward. It seems to be saying, right, okay, we're going to take all these people who've tried to move into other spaces, shove them back into the lit market where the HFT guys are, and actually increase the amount that the HFT guys are there by forcing them to make quotes on an ongoing basis in any instrument where they're following a market-making strategy. It seems very odd to me that somebody didn't look at those bits and think, hang on a moment, that together doesn't sit very well. And we did raise the issue and suggested maybe this construct wasn't the best. The UK, as people hopefully are aware, argued against the caps. We argued for a protection of the waivers and the diversity of trading venues that have developed under MiFID I, which will tend, I think, net to be eroded by the provisions of MiFID II. And we certainly weren't in favour of the kind of provisions in Article 17.3 because I'm not entirely sure how you force somebody to be a market maker. I think you either do it because you want to do it or you don't. And even people who do want to do it know when not to do it, if you know what I mean. Will we be embarrassed? There's a fair chance of it, I guess. But I guess we'll see how it plays out. I mean, when we were at the FSA, I've been around that place for a while. At the FSA before MiFID I was brought in, we kind of did some analysis, and quite a lot of us thought this is going to be damaging to London. And in the subsequent analysis that's been done by just about everybody in the regulatory sphere, the big winner from MiFID I seems to have been London. Why? Because London, I think, adapts very well to what goes on in one way or another. You know, well, people find a way to get a fair bit of business done. So I guess we'll see. But I don't think if there are good outcomes, it will necessarily be because there was this brilliant architectural idea we and the politicians had in mind. I think you've got a lot of ideas pushed by different people, cobbled together into two pieces of legislation that sit alongside each other in a literal sense, but not necessarily in a theoretical, logical sense. And we'll just see how it plays. And that's a terrible answer for a regulator to give, but it's also an honest answer, so I hope you'll forgive me for it.
Thank you.
I'll quote someone that sat on the panel with me that used this phrase at a recent conference, but it was a smaller event, so I won't name them. But the new kind of market structure that's coming out around this was labelled as a sticky, messy pie. So I don't know if that adds to the answer in any way. Any more questions from the audience, please? Yep, right over there on the right, please.
This is Ian Domowitz from ITG. I heard the phrase tradable IOIs. All right. In the U.S., I mean, we call them actionable IOIs, but I think we're talking about the same thing. There's been a severe backlash against tradable IOIs at the regulatory level on the grounds that the quote rules, right, are sort of separate and distinct from how we treat IOIs, and a tradable IOI may be viewed as a quote. Can you simply explain how that works in Europe for those of us who don't understand?
As far as I'm concerned, the tradable IOI is an indication to a client that they can trade, and then they click on it and trade. So it's very much the automation of a cash business where you just prevent the client from having to make the call. It enables you to be able to show explicit quotes to clients in a partnership manner, so it wouldn't be the same for everybody. It's not like a market-making facility from the perspective to the greater market, but it's very much targeted at individual clients.
No, that part I understand. Maybe Tim can help out here. I mean, as I said, in the U.S., there are specific rules around quotes, right? Those rules do not apply to IOIs, right? A tradable IOI is effectively a quote, all right? And it doesn't matter how you put out the quote. Is that a problem in Europe? Is that a problem in the UK, I mean, in particular, or are we sort of beyond that here?
I think probably my headline message would be that the entire debate in ESMA for the last 3 or 4 years has been that actionable IOIs, you may or may not agree with this, but an actionable IOI is the equivalent of a quote or an order, and as a result under MiFIR II it should be made publicly transparent. You might not think that's a great idea, but the gist is basically if it's got all the information for you to be able to trade against it, that's an order or a quote, and get it out there.
Any further comment on that from anyone? Nope. Great. Okay. Thank you very much, panelists.